of all, everyone, thank you so much for joining us today. This is a live webinar for our 2026 multi-asset outlook. My name is Chris Eddy, and I'm head of investments at 10X. Sure, we are already pretty much through January, and it feels like so much has already happened this year. Things are moving very, very quickly. So I think it's worth just taking a step back as we try and do and try and look through some of the noise to try help understand how to allocate assets in this volatile environment, as well as how to build robust portfolios that can deliver outcomes across a range of different scenarios. We're going to follow a pretty similar format to what we usually do for this webinar. We're going to go through what's been driving markets, how the portfolios have performed, and then we'll spend the bulk of the webinar going through a couple of slides in terms of how we see some risks and how the market is pricing assets really across the world, and then finish off with our positioning and how we build portfolios to really deliver robust outcomes over the next 5 years. We definitely will leave some time for some questions. You'll find that there is a Q&A box. Please feel free to drop questions as and when they spring to your mind. I'm going to go through the whole presentation, and then I'll pick up some questions at the end. So please do feel free to engage, and happy to talk through some of those as they come through. Before we jump into performance, I thought it might be just useful. I mean, we do these on a quarterly basis, so every 3 months, and just kind of recap what we've really been talking about over the last 12 months. Going back to really the beginning of the year, we spent quite a few of these sessions really looking at what we believe is a bubble in US equities, and why that's important for us. When you start with such elevated valuations, it doesn't really tell you anything about the next year or the next 6 months or the next 3 months, but it's an incredibly powerful anchor in terms of setting real returns over the next 5 to 10 years. So what we try to do is we try to look out slightly longer and see what the big risks are on the horizon and what the key decisions one needs to make to build robust portfolios. So for us, that's been a key theme we've really been speaking about for sort of 12 to 18 months. Where we're sitting at the end of the year is at a point where we're sitting pretty much started the year in 2025 with really elevated valuations still existing in the US. I think the one big change from last year, though, is what's happened with the dollar, and we'll unpack that a bit more. But that's something we've certainly been talking about and warning about for really the better part of 12 months. We also touched, obviously, on the fiscal situation, not only in the US, but really around the world. And you're starting to see some concerns around government debt sustainability, which is ultimately becoming a bit of a constraint on the ability of governments to continually run fiscal deficits. We've seen kind of the steepening and significant yield rises in Japan, and the similar kind of constraints really exist pretty much across most of the developed market. We also touched on in our mid-year webinar how US policy decisions, specifically around trade, in terms of narrowing that current account, may really be a catalyst for diversification out of a very expensive US dollar, and that's certainly a theme that we've seen playing out. And last quarter, we really spent a bit of time really delving pretty deep into the US equity picture around the AI CapEx cycle, and that's really kicking on to its next leg as we're starting to see leverage come in to the system there. Also a couple of signs around sort of things like vendor financing and the interconnectedness with the private credit market. So that was something we flagged in the third quarter. But really set against this, I think our big theme for 2025, and it rolls forward into 2026, is really around the fact that compared to the last 20 years, you are sitting at a point where in most markets, real yields are the highest they've been over the last 2 decades. And as a result, the risk premiums are really thin when you look at growth asset classes. So that's kind of how we've been positioned and what our big themes were over the last 12 months. And there's not much of a change kind of going forward, but let's unpack what actually happened in markets over the last 12 months. And I think one of the biggest themes has really been dollar weakness. Here we've pulled up the DXY. So that's a basket primarily of developed market currencies against the dollar. And you can see over the period of 2025 that dollar weakened about 11% against this basket, which is quite a significant move. And it was really, a lot of it was front loaded at the start of the year, but it has been consistent. And we've certainly seen that continue to play out in 2026. And off the back of dollar weakness, well, really, you typically find emerging markets do well, developed markets outside of the US do well, and against the backdrop of a softening dollar, you typically see commodities do well, and that's exactly what's played out over the last 12 months. So here we've pulled up a chart that just looks at a number of different equity markets, and we've priced those as total returns in dollars. And what you can really see is that even though the S&P delivered pretty strong returns in dollars, around 17 to 18% over the last 12 months, most other equity markets outperformed the US. And a big part of that was the weakness in the dollar. So if we look at that, MSCI World ex-US is sitting at about 34%. So is emerging markets. So are China. And actually, the good old JSE really was one of the best performing markets over the last 12 months. And you can see there was really pretty much a break from the Chinese market there in the fourth quarter as we saw precious metal prices really start ticking up quite aggressively. So weak dollar has supported the rest of the world. And from a South African perspective, really what's happening across broader commodity markets is a massive tailwind, not only for the South African stock market, but also for the broader South African economy. So here we've really pulled out two of our largest exports to the end of December, platinum and gold. And what you can see is over the last 12 months, platinum was up something like 127%, and gold was up something like 65%. These are really, really big moves, and they make up the bulk of our export basket. So when these precious metals rally, we earn a lot more hard currency. It starts becoming quite a strong underpin for the rand. And equally on the flip side, really our biggest import being Brent crude has really been very soft, which has created and provided a strong disinflationary impulse in South Africa. Really, if we look at it from an equity market perspective, the JSE in rand terms, so this is the all shares, up something like 42%. If you break it down really into the three kind of core key sectors being resources, financials, and industrials, what you can see here is resources have really driven strong returns up something like 144% over the last 12 months. I mean, these are massive numbers. Financials, more SA focused, up something like 27%. Again, really, really strong returns coming into the year on really pretty attractive valuations. And the industrial part of the market, which is more of a rand hedge, delivered about 19%. So you can see as the rand started strengthening quite significantly, that created a little bit more of a headwind for that rand hedge part of the market. But all in all, it's been a great time to be invested in the SA market. We touched on the imports and the exports, and how that comes together is really in our terms of trade. And here you can see the orange line shows the South African terms of trade, and you can see how over the course of 2025, it has really exploded upwards. Now, the terms of trade are a significant underpin for our currency, and together with dollar weakness, has been one of the main reasons we've seen a significant strength in the rand. Now, the relationship here is somewhat correlated. between the rand and terms of trade. But the move in the terms of trade has certainly outstripped the move in the rand. And here we're looking at the real effective exchange rate for the rand, so kind of stripping out inflation and compared to a broad basket of currencies. But what that does mean is kind of given the move in terms of our terms of trade, the likelihood is that in periods of weakness, the rand will probably be less weak. And obviously, the trend, while commodity prices remain elevated, is for the rand to continue strengthening over the next coming months if we see gold and platinum prices stay elevated. I think one of the big stories for 2025 from a local perspective was certainly the reset lower to the new 3% inflation target from the Reserve Bank. Ultimately, the disinflationary impulse into the South African economy started long before that. It was a combination of significantly lower oil prices, a much stronger rand, and some relatively elevated base effects. If we think kind of 18 to 24 months ago, we're starting to go back to that period pre the election where the rand was very weak. You also had somewhat more elevated oil prices, and both of those have come in significantly. And that's created a significant disinflationary impulse in South Africa. You can see that on the blue bar chart on the left-hand side. That just shows CPI year on year. You can see during COVID, obviously, when demand absolutely collapsed and oil went pretty much close to zero, how we breached that 3% level. We then spiked up with the global inflationary impulse off the back of COVID in 21 and 22, with inflation topping up at 8%. And given the factors I've been speaking about, that's really driven strong deflation through, with CPI now coming in below 3% for a couple of months earlier this year. And really that low inflation at about 3% really provided air cover and allowed and probably pushed the Reserve Bank to actually bring forward their decision to push very hard to lower the inflation target. Because when inflation is very low and you reset your inflation target lower, the amount of pain that you need to bear from higher real interest rates is somewhat cushioned. And we've really seen that come through with their ability to cut rates at the back end of last year again as well. And so in an environment with falling inflation, that provides a strong tailwind to South African bonds. And last year, we saw South African bonds really deliver equity-like returns. So across the board from South African asset classes, we've seen really strong returns. It's quite interesting if you decompose the South African bond yield. There are really two components to it. It's that break-even inflation and the real yield. Now, the real yield typically is compensation for things like fiscal risk. It's kind of the risk premium that's embedded based on South Africa's fiscal position. And break-even inflation generally is a measure around how the market is pricing inflation risk in the economy. And what you typically find is whenever inflation falls materially, break-even inflation falls. So it really is more sort of a coincident measure than it is the market's expectation of future inflation. And it's really been that collapse in break-even inflation. So that's the blue bar, the blue stack chart on the right-hand side, which has driven the strong returns to SA bonds. And the real yield is relatively unchanged over the last 12 to 18 months. I mean, at one stage we were up at kind of 5. We're now down to about 4.5. More recently, just under 4.5, between 4 and 4.5. But that hasn't been the big mover. And why that's important as we start looking forward, being able to lock in inflation plus 4 is a very, very attractive opportunity for investors in the bond asset class. Now, something like that probably might not seem that exciting when you're seeing returns of 25%, 40% plus to SA equity. But one needs to think about what are reasonable long-term return expectations through the cycle, because we certainly are in quite a highly cyclical environment. And the ability to kind of bank something like inflation plus 4 to 4.5 to 5 in a relatively risk-free way is quite a good outcome and strong underpin for South African asset returns going forward. From a performance perspective, I mean, we already alluded to the fact that South African assets have been some of the best performing. Here we're looking at the 3-month and the 1-year returns to different asset classes. And what you can see, for the first time in really a very long time, South African equities significantly outperforming developed market equities. And really across the board, South African asset classes delivered strong returns. So you can see the lowest South African asset class here that we have bought up is cash at 7.5%. And if you think that inflation's coming in around 3.5%, well, that's quite a handsome and chunky real return that you're getting from such a defensive asset class as well. Then you step up to things like inflation-linked bonds, you're getting 16%. Nominal bonds, 24%, which is that very much equity-like return I was talking about. And in an environment where the rand strengthens quite materially, what we've seen is that offshore asset classes have lagged local asset classes given the headwind of a much stronger rand. So global bonds and cash really delivered negative returns for a rand-based investor, and global growth assets, certainly developed market, and more specifically, those US equity market exposure was lagging the rest of the world. But I think the key takeaway here is that it's been a great real return environment. It's been a fantastic time to be invested in markets. And that's really kind of showed up in performance. So from the 10x Your Future Fund, we've delivered more than inflation plus 16% over the last 12 months. It's a real return of something like inflation plus 13, which are really chunky. Our overall defensive positioning through 2025 has seen us deliver slightly softer returns than the peer group, and that's primarily due to higher allocations to defensive assets across global bonds and local inflation-linked bonds and cash. What has worked quite well for us has certainly been our global equity positioning in terms of our overweight to emerging markets in China, as well as our overweight to developed markets, excluding the US. And we really are in an environment where we've seen risk premiums compress massively over 2025, and we'll touch on that a little bit later. But it's that environment where expensive asset classes got slightly more expensive, and we certainly are at a point where we don't think it's the right time in the cycle to be taking on significant risk. I think a great way to think about this and contextualize this is if we look back over the last 5 years, the average high equity balance fund after fees has delivered something like inflation plus 9%, between 8 and 9%. Now, typically through the fullness of time, a high equity balance fund will give you something like inflation plus 5 to 6. That's what most of the long-term modeling will do. That's what most of kind of the managers in the industry are targeting. So if the last 5 years has given you sort of inflation between inflation plus 8 to 9, but the average over the long term is inflation plus 5 to 6, there's a good chance that kind of looking forward over the next 5 years, we might move through into a slightly softer return environment where we get back to kind of closer to those longer term averages. So you can think about an environment like CPI plus 3 to 4 together with CPI plus 8 to 9 gets you back closer to that inflation plus 5 to 6% long-term average. So we've certainly seen great returns, but with relatively compressed risk premiums, we're actually comfortable with defensive positioning. Why? Because the outcome to the end investor is still very sizable in terms of real returns if risk assets continue to rally. Whereas if we see the picture turn around somewhat, it's the ability to compound those real returns consistently through time, which is key. So as we look ahead from here, we've got a couple of market observations into 2026. 2025 was really the year of increased breadth. What do I mean when I say that? Well, then I'm talking about rather than the US equities being the only game in town, markets around the world started delivering strong returns. We saw emerging markets ex-US. So it was the year to be diversified. And we believe that this may be a trend that continues for some time. This is coming from a chart that we did earlier in the year. We've rolled it forward and updated it to the end of the year. what we're really looking at here in dollar terms is the performance of US equities relative to the performance of developed market equities outside of the US. And you can see that markets move in long-term cycles from kind of the early 70s all the way through to the late 80s for a period just under 20 years. You consistently had the rest of the world outperforming the US by something closer to sort of 40% over that period. And then if you go from the late 80s through to the dot-com bubble in 2000, you can see that the US significantly outperformed the rest of the world. And over that period, again, really showing outperformance to the quantum of about 40 to 50%. Roll forward the dot-com boom, US equities burst, and they went nowhere for a full 10 years. That was the last decade to US equities during the 2000s. And I think a concept like that is probably quite difficult to consider when we've seen what US equities have done over the last 15 years. But it does create a warning around starting point valuations. Emerging markets, the rest of the world, significantly outperformed in the last commodity bull run during the 2000s. And then pretty much from the lows in the GFC, kind of 2009, 2010, it's been pretty much a one-way train with just US outperformance. Last year was the first year that we kind of saw a little bit of a blip in that, with the rest of the world outperforming. And I guess the question going forward, as you think out the next 5-10 years and really focus on the right key long-term trends to get, is to understand, is this just a blip in a one-way train to US equity outperformance, or is this potentially a turning point in the cycle? To help kind of think about that, we have also looked at the dollar here. Now we know, and we spoke about how during 2025 there was significant dollar weakness, and you can see that on the chart. Let me bring up a little, see if I can bring up a pointer here. No, I'll leave that. But you can see on the right-hand side of the chart how that dollar weakness came through. But if you look out over the longer term and over a slightly longer term trend, what you can actually see is that the dollar is actually, despite that soft performance, still pretty elevated and pretty expensive on a real effective exchange rate perspective. So here, this is looking at the broad dollar against a basket of currencies in real terms, and kind of relative to where that sort of PPP fair value is, you're still kind of more than 10% away. That would be the dotted line. But I think the interesting observation to make on this chart is that you very rarely see kind of the currency settle at what that fair value based on sort of PPP is. It typically tends to overshoot and then significantly undershoot, and we've seen that over a number of prior periods. And the interesting thing when you think about it, and this is obviously relevant as an investor who's investing, it doesn't matter whether your home currency is dollars or your home currency is rands or your home currency is euros. The currency plays a large role in the end return that you get from investing in assets. And there's a little bit of a sort of a base effect in here. But what you can see is that if we overlay that same relative outperformance chart of US versus ex-US with those long-term dollar cycles in terms of the real effective exchange rate, you can see that they kind of move together in somewhat of a rhythm and kind of rhyme together. And so what you can see is sort of from the 70s, throughout the 70s, you had the dollar significantly weakening and you had ex-US outperforming. Then sort of from the 90s, you had the dollar strengthening materially and the US outperformed. And then the dollar weakened during the 2000s and the US underperformed. And really, again, from the lows in sort of 2009, you've seen the dollar strengthen quite significantly. And we've had a bit of a crack, but we're still quite far away. So if we see continued dollar weakness going forward over the next couple of years, I think one can expect the environment to be much more supportive for assets and equities outside of the US going forward. And And it's quite interesting when you overlay sort of some of those long-term trends and cycles with really what the composition of the underlying market is. Here we're looking at kind of really the weights of the US, Europe, and Japan in the MSCI World Index. And what you can see is that the US, I think the number most recently is something like 72%, but makes up between 70 and 75% of global equity markets, given the run that we've seen over the last 15 years. So really what that's saying is if you're allocating to global markets, global market cap indices, you pretty much have a significantly concentrated bet really in one market. And there's not that much broad diversification if we see the cycle start to turn. And so that's something one needs to think about based on how you are positioned in your portfolios. What's the total look-through exposure of your global equity portfolio? How much do you have allocated to the US? How much do you have allocated outside of the US? Because we really are, from a concentration perspective, kind of at previous sort of peak levels of sort of the 70s Nifty 50 era, which was a big US bubble that burst and led to the rest of the world outperforming during the 80s. Now, that's kind of been a lot of sort of, let's say, sort of macro positioning, macro talk. We're talking about an expensive dollar despite the weakness over the last 12 months. We're talking about sort of positioning from the composition of a global market equity index. But valuation and the valuation disconnect between US and ex-US could provide a further fundamental underpin for the trend and the cycle to change going forward and for continued ex-US outperformance. So what we're showing here is we're showing really the long-term valuation metrics we like to use, the CAPE ratio over a very long-term time period, really going back more than 30 years here. And the purple line is really the CAPE ratio for the S&P 500. The darker line is the CAPE ratio for developed markets outside of the US. And what you can see is that along with stronger earnings, which was kind of certainly being rewarded in the US, you've had a step change up in valuations as well. Kind of during the from 96 through to kind of 2010, developed markets sort of moved in lockstep from a valuation perspective. There were some disconnects, but no material disconnects. But really, since sort of 2011, we've seen continued valuation expansion in the US, where the CAPE ratio is really now sitting at previous other sort of bubble levels in terms of the dot-com bubble and then kind of the January end of the COVID spike before the sell-off in 2022. So valuations are looking very stretched. When we look at the ex-US, it's an interesting observation. I mean, the rally that we've seen over the last 12 months has actually pushed those valuations slightly above fair value. But relative to the extent that the US is overvalued, there's a significant relative undervaluation to that ex-US exposure, which could provide sort of another arrow in the support for a change in trend between US and ex-US performance going forward, because starting points are key and that matters. But I think one can very easily get lost in relative valuation between equity markets. I think what one needs to also consider is what is the absolute level of valuation across markets. And here we've really looked at and kind of converted those valuation metrics into Z-scores. It's just kind of a fancy term to say how expensive, how many standard deviations expensive or cheap is the market sort of to that long run average. And what you can see is we've got kind of a range between 1 and -1, and then a range between 2 and -2. And kind of developed markets ex-US are sort of, they're slightly expensive, but they're not even one standard deviation expensive. Kind of anything sort of between that +1, -1, you can kind of consider sort of somewhat fair value. But from the US perspective, it's more than 2 standard deviations expensive, which just tells you really kind of how expensive that market is in absolute terms. And really what that's saying is that equities as an asset class are priced pretty kind of fairly to rich across the board wherever you look. And if you compare that to other asset classes in a multi-asset portfolio, here we're doing it versus real yields on bonds, is that the relative attractiveness or the risk premium between equities and bonds is pretty much as narrow as it's been over the last kind of 20 years. And you can see it's continually kind of stepped down. Both those equities have continued to grow and become more expensive as the markets rally. But equally, as we've seen real yields step up quite significantly, you can think of this sort of equity risk premium as the additional compensation for bearing equity risk over and above fixed income across different markets. And here what you can see is while the trend has been tighter and tighter and tighter risk premiums, it's certainly the US that is significantly lower than the rest of developed market equities. So that's kind of a picture and a frame. I think we think it's one big decision that investors need to get right. And it's certainly not saying that one should be all in on US or ex-US, but it's really key to consider how well diversified you actually are in terms of your global equity positioning and evaluate whether now is the right time to potentially lean into parts of the market that can drive better diversification and potentially deliver better real returns on a forward-looking basis. And that's certainly what we're doing in the portfolio. When we start looking at and shifting from the sort of US ex-US perspective and a couple of observations in terms of sort of US policy, I think the one interesting longer-term observation is that kind of inflation has certainly come in globally from what we saw in 21 and 22. But it certainly seems and appears like it is pretty sticky. They always say like the last mile is the hardest. And it really seems to be kind of anchoring and leveling out closer to 3% than the central bank's target of 2%. And here we pulled up both US CPI and core PCE, which is kind of the Fed's preferred inflation measure. And you can see really over the last sort of 18 months, it's kind of been oscillating closer to 3%, and we certainly haven't got down to that 2%. Now, what's interesting about that is we've seen a number of interest rate cuts from the Fed over the last really 18 months. I mean, the interest rate cutting cycle started back in August, September 2024. And the back of last year, we saw another couple of cuts from the Fed. And they've been comfortable with cutting interest rates, even though that core PCE measure is sort of oscillating around 3%. And it appears to have sort of leveled off there. So what does that tell you? Well, it tells you they're probably slightly more concerned with their growth mandate with full employment than they are with inflation. Now, there are a couple of risks around that. We know that we're in an environment where the US, and we covered it in previous examples, has been running significant fiscal deficits. So there's been a lot of fiscal stimulus. These interest rate cuts continue to provide more monetary stimulus into the economy. And that's happening at a time when inflation hasn't really been contained and is not back down to target. I mean, we alluded and we covered this quite a bit in some detail in the previous webinar. But really providing support like this into an environment where you have equities at record valuations, credit spreads at record tight, conditions incredibly loose, certainly does risk a sort of a run it hot, blow off top environment. And obviously the risk around that is that inflation starts rearing its head again. Now, it's quite interesting if you contrast what's been happening in the US labor market. So here you can see there's two lines. We pulled up the US employment rate in purple. Obviously, there was that big spike up in COVID, which has been lobbed off the top of this chart just so it's more legible. But you can see employment basically bottomed in 2023. And since then, it has been gradually getting weaker. Now, the big concern around that is if you look at long-term employment cycles, what typically happens is that unemployment never really stays constant at a level. And historically, whenever you've seen sort of gradual weakening, it's very quickly followed through into quite a significant uptick in unemployment. And that's what the Fed's really been pretty concerned about. And that's why they really have cut interest rates, even though the market environment certainly seems like it isn't in need of rate cuts currently. I've also plotted US job openings because I think it's quite an interesting observation. So we know that the labor market provided a very strong underpin for inflation during COVID. You can see how high job openings were in 2021, 2022. And the labor market's cooled a bit from a job opening perspective. You've seen that come in quite materially to where we are now. It's sort of leveled off over the last 12 months. But if you look back over the longer term, besides a short period in 2018, job openings are still much more plentiful than they were throughout the period from 2017 all the way back to 2000. So what does that tell you? Well, it tells you the job market's cooled somewhat, but actually it's still relatively elevated compared to the long term. So you can think about it as still being somewhat tight, even though we're in a sort of a no hire, no fire environment where the unemployment rate has kind of sort of stayed relatively steady. The risk of that, of course, in an environment where you're seeing sort of strong fiscal impulses coming through, additional monetary policy support coming through, is that that could tighten quite significantly pretty quickly and lead to sort of a pass-through in inflation going forward. So that's the risk from a policy perspective. And ultimately, I would say that inflation is ultimately acting as a constraint around further policy support from this point going forward. I mean, you've actually seen that as well. The market has significantly priced out a number of interest rate cuts in the US over the last 2 to 3 months. So going ahead, the market said it's settling at about 2%. The US bond market is really only pricing inflation down at 2%. I mean, here we plotted the 5-year break-evens and the 10-year break-evens, and they're really anchoring around that 2.5%. So what that's saying is, even though many people are talking about concerns around elevated inflation, concerns around central bank credibility in terms of who Trump will appoint as the next Fed chair and whether they will cut interest rates regardless of the inflation environment, or concerns around fiscal risk, it looks like the market is still pricing inflation as pretty anchored, and that's coming through. So the market is not pricing risks of inflation or necessarily policy credibility in the bond market itself. And really what you're seeing is the tick up in bond yields has all been driven by the real yield component. And that's quite important, because really what you're seeing here is that bond investors are now being more adequately compensated for owning fixed income as an asset class compared to where they were pretty much over the last 20 years. It's quite interesting when you look through the rearview mirror, and recency bias can be quite a thing. When real yields were -2%, -3% over 2019, 2020, 2021, fixed income was a fantastic asset class. Everyone wanted to be in it, even though there was no compensation for owning it. What have we seen over the last 3 to 4 years as yields backed up? Well, in some parts of the bond market, bonds have sold off north of 45%. I mean, that's a GFC-like event compared to equity markets. And now once bonds have lost 45% because we're now back in a territory of real yields, everyone's looking at kind of some of the risks around inflation, some of the risks around fiscal sustainability and potentially central bank credibility, and saying, well, you know what, we don't want to own bonds now. The reality is, because there are some increased risks at this point in time, there's also much better reward to stay elevated. Investors are being rewarded for owning fixed income and bonds as an asset class. It's the break-even component that one needs to think about, because actually in an environment where you have lack of policy credibility and the debasement trade has been what's been pretty popular now. What that actually looks like is an environment where real yields go negative and break-evens widen significantly, something like you'll see in some emerging markets like a Turkey, for instance, is a nice analogy and way to think about it. But as long as real yields stay elevated, investors are being compensated for owning fixed income. And it's quite interesting. Everyone's saying, okay, you also need to be very much short dated in terms of your bond exposure. You don't want to own duration risk because of many of the risks that we've alluded to in terms of inflation and fiscal sustainability. But what's quite interesting here, we're looking at sort of the term premium. You've got the term premium back to kind of levels that I would say are somewhat normalized if you kind of draw a straight line through that going back. That's kind of the sort of the lower end to sort of the average term premium instead of the negative environment that we've been in for the last decade. So again, there are some more elevated risks on the horizon, but investors are also being somewhat more compensated for owning those risks. And again, from the bond side, as long as you're earning that real yield, that compensation exists for the risk that you're taking. If you contrast the real yields on offer across government debt and compare that to something like credit, we see credit spreads are significantly compressed across the board. Here you've got US investment grade credit. Some of the tightest spreads we've seen going back on record. Pretty much the only time we've seen really tighter spreads was sort of during the mid-90s. And what that's saying, again, is that you've got significantly compressed risk premium in this asset class. You're not being paid very much for taking on credit risk. And our process is really centered around understanding what we paid for taking risk across asset classes and then allocating to asset classes where we're being compensated for taking that risk. And there certainly aren't signs of it, of adequate compensation in investment grade credit today. We touched on the private credit market in a little bit more detail in the last webinar, but just tracking what's happening there. There are these BDC companies or listings which are effectively listed private credit vehicles. And what you can see is that the private credit space has significantly underperformed the listed credit space. Here we're just showing total return indices to Bloomberg US High Yield Index and that of the S&P BDC Index. And you can see that sort of as a proxy for private credit with a lot of volatility through the year, it's kind of down sort of 5% over the year, while high yield credit is up closer to just under 10%. And again, over the weekend, just a couple of interesting headlines around how you're starting to see fair marks coming back into what is a relatively illiquid asset class, with a BlackRock private credit fund taking a 19% lock hit and markdown in terms of its NAV. There was another total loss to an Apollo-backed asset-backed exposure. So you're starting to see signs where private credit as an asset class has really been overextended and risks starting to rise to the surface that one needs to be aware of, given how the asset class has grown in significant size. But I think probably the story of the year for the last 4 weeks started last year, but it really has been what's happening in precious metals. So in an environment where you've got kind of very loose fiscal stimulus, very loose or looser monetary policy than what is required, given where inflation is, given the financial conditions backdrop, that excess liquidity has certainly found its way into precious metals. And compounding that with the weaker dollar, we've really seen what can only be described as a parabolic move in precious metals. I mean, I've showed a long-term chart here going back to 1996. But just to give you a sense of what's actually happened over the last, call it 12 months since the start of 2025, gold is up 130%, 2%. And this was, as at this morning, I updated this chart. So up 102%, platinum's up 199%, silver's up just under 300%. I mean, these are such significant moves for an asset class. And actually, as we touched on earlier, fantastic for South Africa, for the South African economy, given our reliance still on precious metals as a large export. Fantastic for the South African rand going forward. But one does need to have a measure of caution and risk, because when you see lines going straight up like this, there's obviously kind of the risk that they come straight down on the other side. And that's something that we've seen really across the board. And so as we think about it and as we look back, I mean, the moves here have been really remarkable. We still think asset classes like US equities are in a bubble. Where precious metals are and where they settle, it's incredibly difficult to say. But there certainly is risk associated with the move that we've seen here. Now, when we think about this from a South African equity market perspective, obviously what's happening in precious metals has been a significant underpin to the strong returns we've been seeing in South African equities. But that doesn't come without risk, because the concentration in the South African equity market has gone parabolic, just like the metal prices over the last 12 months. I mean, if we think about concentration risk in SA equities, I think everyone's mind goes back to Prosus and Naspers when they were sort of on a combined basis in the region of 25 to 30%. We're now sitting at the point where gold and platinum shares make up 30% of the FTSE JSE All shares. So 1/3 of your SA equity exposure is sitting in these precious metal counters that have obviously significantly benefited from the parabolic move up that we've seen in precious metal prices. But it's a risk that one needs to think about as we look out ahead over the next year or two. Now, the earnings to these miners are going to be very strong given what's happened with the precious metals prices. But what I would say, and we think about this through how wide are the range of outcomes from this starting point, the range of outcomes for something like SA equity is significantly broader than one would typically imagine, both not only to the upside if we see a continuation in the move in precious metals prices, but if some of those reverse somewhat quite significantly, given the large weight of gold and platinum shares, we certainly could see a risk to the downside as well. So as we sit today, it's certainly an asset class that one needs to own. Even though it's got more expensive, it's still certainly nowhere near as expensive as we're seeing in markets like the US. But one just needs to be cautious around the risk around your really look-through exposure in the asset class today. When we compare from a South African equity perspective to South African bonds, we've seen the same narrowing of risk premium in SA equities, really underpinned by the run in precious metals. So again, that risk premium between SA equities and SA real yields that are sitting around 4.5% is pretty much as low as it's been going back more than 25 years. So again, it just warrants some caution from how much risk you take from this starting point going forward, given the dispersion of outcomes that one can expect going forward. And that really sort of covers everything that we wanted to touch on. I mean, there's a lot of information there. I understand that a lot of the charts are quite data heavy. So really to try to take a step back and consolidate some of the observations that we've made here. The first is obviously around US versus ex-US. We've seen that 2025 has been a very strong year for ex-US performance. The fundamentals, the starting point, the dollar still remains overvalued, even though it was a lot weaker. Relative valuations are still much more expensive in the US, and potentially we may be at a turning point from a regime in terms of kind of US versus ex-US underperformance. The fundamentals from a valuation perspective on both the currency and the equity market support the continuation of ex-US performance, and investors at this point in time just need to be cognizant of how much exposure they have to US versus ex-US. In an environment where there certainly are risks of kind of a run-at-hot policy response, both from a fiscal perspective and a monetary policy perspective, it's inflation that ultimately is the constraint around the ability to really sort of juice the economy from that perspective. And it's if really, despite elevated and maybe increasing inflation, that policy stimulus continues, that's really, I think, where the idea of sort of financial repression and debasement would start raising its head. But that would ultimately should be accompanied with more lower and or even negative real yields. So owning inflation-linked bonds in that type of environment provides quite a nice asymmetric outcome. Given the elevated real yields that we are seeing across bonds, now is not the time to dump it as an asset class. That time was 5 to 6 years ago, unfortunately, before the asset class took a 40% loss, not when you actually have real yields in the asset class and actually steeper curves again for the first time in a long time, where investors are being compensated for the risk of owning bonds, not necessarily what the short-term inflation view is. SA as a market, SA as an economy, we are incredibly geared and to the precious metal cycles. We know that this is a very cyclical cycle. It's incredibly powerful for not only our economy and our stock market and the currency, but it is very volatile, and there are a wide range of outcomes going forward. But as an SA investor, it's certainly an asset class to own. And really, wherever we look, and I think this is really kind of the big key observation, whether it's equities, whether it's credit as an asset class, wherever you look, risk premiums, same thing for inflation risk premiums. Risk premiums are very thin. Asset classes have rallied significantly and they've compressed. And what that means is that they really are discounting a fantastic outcome, both in terms of growth, in terms of growth being robust, in terms of inflation coming in low, and in terms of earnings delivering. That's what the market's expectation is currently. If we see any wobbles around some of these risks, I think one needs to think about both really to the upside and to the downside across a range of scenarios, how your portfolio is positioned and how it can deliver returns, not just for one scenario, but for multiple different scenarios. Because as we move into an environment where leaderships may change, where regime shifts certainly could be to the fore, what worked over the last 5 years, what worked over the last 10 years, probably is not going to work over the next 5 to 10 years. So investors just need to bear that in mind. Now, today we've really spoken about some really market observations that we make. It helps to contextualize the environment that we're in. However, the way that we build portfolios to deliver real returns over the next 5 to 10 years is really anchoring on what we're being paid to own risk. And the way that we do that is we set real return expectations across a range of asset classes in rands, looking out ahead over the next 5 to 10 years. And we really evaluate that against what the different asset classes have delivered over the long run. And what you can see pretty consistently is that defensive asset classes, underpinned by the highest real yields we've seen in 20 years, are set to deliver returns that are above their long run average. I mean, typically what we've seen in South African bonds and cash have given you between sort of 1 to 2% over a long-term real horizon. Similarly, for a South African investor, global bonds and cash have given you something like 1 to 2% real once you convert those back to rands. But where we're sitting today, the outlook for those asset classes are certainly slightly higher. The challenge, however, is for investors who are looking to hit that inflation plus 5 to 6. Given the elevated valuations that we're seeing across the board from a growth asset perspective, that might be quite a difficult challenge through the fullness of the cycle. We're seeing those compressed risk premiums, nowhere more so than in US equities, where under our framework from this starting point, not for the next 6 or 12 months, but for the next 5 years, certainly are looking at potentially an environment of zero real returns going forward. Should we see a sort of a normalization of valuations to something that is not really sitting in bubble-like territory. And one is certainly better off from a real return perspective, allocating more broadly across the globe to developed markets, ex-US, to emerging markets. Interestingly, emerging markets are also pretty bifurcated, with China being kind of more fair valued after being uninvestable a year ago. It delivered really strong returns, but there's still pockets of expensive markets in the rest of Asia there. And SA equities really underpinned by still elevated real yields, still a strong dividend yield in the region of 3.5% to 4%, create an environment of delivering real returns going forward. So against that backdrop, with real returns more favorable in defensive asset classes and less favorable in growth asset classes, our portfolio remains more defensively positioned versus our risk neutral through the cycle benchmark of a 70-30 growth asset defensive asset class split. We're sitting at 63% growth assets, so we underweight growth assets, and that's primarily coming from DM equity, and within that primarily from US equities itself. We overweight inflation-linked bonds, both locally and globally within our bond carve-outs, and we remain well diversified from an onshore and offshore perspective. Our offshore exposure is predominantly diversified away from the US dollar, given that we're still sitting, despite the recent weakness, at a relatively elevated perspective. So we're somewhat conservatively positioned. We're positioned to deliver pleasing real returns going forward. If we see another year of stellar returns to growth assets, kind of in the region of 20, 30, 40, 50%, our portfolio will deliver fantastic real returns to investors. Might be slightly softer than portfolios that are taking lots of risk. But at this point in time, we don't think investors are being adequately compensated for taking significant amounts of risk. If your objective is to deliver strong and consistent real returns over the next 3 to 5 years, there will certainly be a point in time to increase risk over the next couple of years. But historically, it's never been a great tactic to chase markets towards a late cycle environment when valuations are somewhat elevated. So we are more conservatively positioned, and we think that will serve investors well as soon as you start stretching out your time horizon. I see we've hit 12 o'clock. So it is the end of the session today, and I want to thank you all for joining our session. The slide deck will be available, and if you do have any further questions, please do reach